Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics. But until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
So the thing about capital requirements is there would be a 90-day comment period, roughly, something like that, could be in that range. And then there would be a long period of considering those, the comments that are made, and then there would be movement toward coming to an agreement about what to finalize. And after that, so that would take many months, and then you would be into a situation where there would be long phase-ins. So I don't really think capital requirements play into the near-term economic situation the way interest rate hikes do.
Chairman, according to the Bureau of Labor Statistics CPI inflation calculator, it takes $1.16 today to buy the same consumer goods and services as $1 purchased when President Biden took office in January of 21. Do you agree that outsized inflation we have seen since early 2021 has caused and continues to harm workers, retirees, and families trying to make ends meet and pay their bills?
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.